What if I told you the biggest economic shift of the 21st century isn't happening on Wall Street, but inside massive, power-hungry data centers? The AI investment boom is exploding across the globe, pouring trillions into companies like Nvidia, Microsoft, and Google. But this isn't just a tech story, it's an economic earthquake. Artificial intelligence is reshaping productivity, disrupting labor markets, straining electricity grids, and concentrating wealth at the top. Is this the next dot-com bubble, or the birth of a new economic order? In this documentary, we break down the AI investment surge, the hidden infrastructure crisis, the productivity puzzle, and the real impact on jobs. If you want to understand the future of the global economy, market concentration, AI stocks, and economic inequality, you're in the right place. We are living through a modern gold rush, but instead of shovels and pickaxes, the tools are GPUs, data centers, and trillion-dollar balance sheets. The AI investment boom is not just a tech trend, it's a capital tsunami. Governments are pouring in subsidies. Venture capitalists are throwing around billion-dollar checks like confetti. Corporate giants are racing to build infrastructure at a speed that would make the railroad barons of the 1800s blush. Names like Nvidia, Microsoft, Google, and OpenAI have become the new oil barons of the digital age. Their quarterly earnings don't just move stocks, they move entire markets. A single earnings call can add or erase hundreds of billions in market value overnight. That's not hype, that's systemic impact. But here's where it gets interesting. Unlike previous tech booms, this one isn't just about software apps or social media platforms. This is physical. Brutally physical. AI runs on data centers. Data centers run on electricity, and electricity runs on infrastructure that many countries haven't seriously upgraded in decades. The digital future is colliding headfirst with aging power grids. Every time a company announces a new AI supercluster, somewhere an energy executive quietly panics. In places like United States and China, AI deployment is accelerating so fast that electricity demand forecasts are being rewritten. Data centers are no longer just warehouses full of servers. They are power-hungry industrial machines, consuming as much electricity as small cities, and suddenly, the bottleneck isn't talent. It isn't chips. It isn't even capital. It's power. Welcome to the infrastructure challenge. The AI revolution is forcing policymakers to confront an uncomfortable truth. You cannot scale intelligence without scaling energy. Renewable projects that once seemed optional are now strategic necessities. Nuclear power is being reconsidered. Grid modernization, a phrase that used to put audiences to sleep, is now investor gold. A new asset class is quietly emerging, sustainable digital infrastructure. It sounds boring. It isn't. It's where climate policy, geopolitics, and trillion-dollar AI valuations intersect. Investors aren't just buying AI startups anymore. They're buying transmission lines, solar farms, battery storage, because without them, the algorithms simply don't run. And yet, amid this frenzy, a haunting question lingers. Is this sustainable growth, or a beautifully engineered bubble? The dot-com era promised infinite productivity. It delivered pets.com. Today's AI boom promises to reinvent medicine, finance, defense, education, basically civilization itself. But capital expenditure is exploding at a pace rarely seen outside wartime mobilization. When companies spend tens of billions before proven returns materialize, history whispers caution. Still, optimism dominates. Surveys of chief economists suggest strong productivity gains are coming, especially in the US and China, and soon. Within 2 years, many expect measurable economic boosts. That's not small talk. That's macroeconomics, shifting. But here's the twist. The benefits are highly concentrated. A handful of mega firms are capturing most of the gains. Smaller markets, slower adoption, developing economies, even slower. If AI truly is the new electricity, then right now it's being wired primarily into penthouses, not villages. And that concentration has consequences. Because when growth clusters at the top, inequality widens. When capital floods into a narrow group of firms, market dominance hardens. AI is not just reshaping productivity, it is reshaping power, corporate power, national power, geopolitical power. So this isn't just a tech story, it's an energy story. It's a capital market story. It's a labor story. And above all, it's a story about who controls the next economic era. The AI investment boom isn't coming. It's already here. And the ripple effects, we're only just beginning to feel the first wave. Artificial intelligence may feel weightless, just code floating in the cloud, but in reality, it is one of the most energy-hungry industrial revolutions in modern history. Every AI model trained, every chatbot query processed, every automated system deployed requires massive computing power. And computing power requires electricity. Lots of it. Here's the uncomfortable truth. The AI boom is slamming directly into the physical limits of global energy infrastructure. In the United States, electricity demand, which had been relatively flat for years, is suddenly rising again. Why? Data centers. In China, regional grids are already under pressure as industrial demand meets digital expansion. Europe faces similar strain, complicated by energy security concerns that intensified after geopolitical disruptions. Data centers are no longer quiet background facilities. They are becoming some of the largest electricity consumers in entire regions. A single hyperscale AI data center can consume as much power as a mid-sized town. Multiply that by hundreds of new facilities planned worldwide, and you begin to see the scale of the problem. The tech giants know this. Companies like Microsoft and Google are not just investing in AI models, they are aggressively securing long-term energy contracts. Some are investing directly in renewable energy projects, others are exploring nuclear partnerships. When software firms start behaving like utility companies, you know something fundamental has shifted. Energy has become the new choke point, and that choke point is creating both risk and opportunity. Let's talk risk first. If energy supply cannot scale fast enough, AI deployment slows down. That means capital sitting idle. It means delayed returns on billion-dollar investments. It means markets that priced in exponential growth may suddenly face physical constraints, and markets do not like constraints. Now let's talk opportunity. The phrase sustainable digital infrastructure sounds like a conference buzzword, but it's quickly becoming one of the most important investment themes of the decade. Grid modernization, battery storage, solar farms, wind power, even next-generation nuclear. These are no longer just climate initiatives, they are AI enablers. The irony is almost poetic. AI was supposed to be a software revolution. Instead, it's triggering a hardware renaissance. Transmission lines are being reassessed as strategic assets. Power plants are being reconsidered through a national security lens. Countries are realizing that the race for AI dominance is not only about algorithms, it's about watts. And here's where geopolitics enters the chat. Nations with abundant, reliable energy suddenly have a competitive advantage in AI deployment. Energy independence now overlaps with technological sovereignty. The global balance of power could tilt not just based on chip manufacturing, but on grid resilience. That raises an uncomfortable possibility. Could energy shortages create an AI divide? Wealthy, energy-rich regions accelerate into the future, while others lag behind, not because of lack of talent, but lack of power. This is the silent tension beneath the headlines. On the surface, we see record-breaking stock valuations and flashy product launches. Beneath the surface, utility executives are recalculating load forecasts. Regulators are scrambling to approve infrastructure permits. And communities are debating whether they even want massive data centers in their backyard. Because data centers don't just consume electricity, they consume water for cooling. They consume land. They reshape local economies. The AI revolution, it turns out, is not virtual at all. It is deeply physical, deeply political, and deeply economic. And if electricity is the new oil, then the companies and countries that control it will quietly shape the next decade of technological power. The question is no longer whether AI will grow. The question is, can the grid keep up? Every technological revolution comes wrapped in a promise. Steam power promised industrial dominance. Electricity promised mass production. The internet promised infinite connectivity. And now, artificial intelligence promises the ultimate prize, productivity. Economists love that word. Productivity is what makes economies grow without inflation exploding. It's how wages rise without companies collapsing. It's the holy grail of sustainable prosperity. And AI, we're told, is about to unleash a productivity boom so powerful it will rewrite economic forecasts. In the United States and China, many chief economists expect measurable productivity gains within just 2 years. That's remarkably fast in macroeconomic terms. Usually, it takes decades for new technologies to diffuse through entire economies. So why the confidence? Because AI doesn't just automate repetitive labor. It augments cognitive work. It drafts legal briefs. It analyzes medical scans. It writes software code. It designs marketing campaigns. In theory, that means white-collar productivity, long stagnant in many advanced economies, could surge. If productivity is about doing more with less, who exactly benefits from that less? At the moment, the gains are heavily concentrated. A handful of firms, think Nvidia, Microsoft, and Google, are capturing disproportionate returns. Their market capitalizations have ballooned. Their margins are expanding. Their influence over digital infrastructure is growing stronger by the quarter. Meanwhile, smaller firms face a dilemma. AI tools can boost efficiency, but implementing them requires capital, expertise, and integration costs. Not every business can afford to rebuild workflows around machine intelligence. On paper, AI is everywhere. Headlines scream about transformation. Venture funding flows like champagne at a tech conference. And yet, aggregate productivity statistics, the boring government data that actually measure output per hour, haven't exploded. Not yet. We've seen this before. During the early days of the internet boom in the 1990s, investment soared. Stock valuations went vertical. But productivity gains took time to materialize. Eventually, they did, but not before a painful correction. So the obvious question emerges, is AI different? Optimists argue yes. AI integrates faster than previous technologies. Cloud infrastructure allows instant deployment. Software updates roll out globally overnight. This isn't factories slowly replacing steam engines. This is code replicating at digital speed. Skeptics raise an eyebrow. They point out that massive capital expenditure doesn't automatically equal economic value. Companies are spending tens of billions building AI capacity before fully monetizing it. If returns lag expectations, markets could reassess sharply. And then there's inequality. If AI-driven productivity gains accrue primarily to large firms and highly skilled workers, income gaps could widen. Regions that already dominate technology could pull even further ahead. Emerging economies might struggle to capture the same upside. In short, AI might increase the size of the economic pie, but the slices could become more uneven. There's also a political dimension. When productivity rises without broad-based wage growth, public frustration tends to follow. Economic growth that feels invisible to ordinary workers can quickly become a policy battleground. So we're left with a fascinating tension. AI could be the productivity miracle economists have waited for since the early 2000s, or it could become a high-cost investment wave that benefits a narrow elite while leaving broader growth disappointingly modest. The data over the next few years will matter enormously. If productivity numbers surge, the AI boom becomes self-justifying. If they stall, the bubble narrative grows louder. Either way, one thing is certain. The AI investment boom isn't just about smarter machines. It is about whether the global economy can finally break out of its slow growth trap, or whether we rewatching history rhyme with the dot-com era all over again. Now we arrive at the part that makes everyone slightly uncomfortable. It's one thing for AI to consume electricity. It's another for it to consume jobs. For decades, automation mainly targeted physical labor, factory lines, warehouses, repetitive mechanical tasks. But artificial intelligence is different. It doesn't just lift boxes. It drafts contracts. It edits videos. It writes code. It analyzes financial statements faster than entire analyst teams. This is not a blue-collar disruption story. It's a white-collar awakening. In the short term, the next 2 years, most economists expect only modest job losses. Companies are experimenting. AI tools are being integrated gradually. Human oversight is still required, and businesses are cautious about ripping out entire departments overnight. But zoom out 10 years, and the outlook becomes sharply divided. More than half of surveyed experts expect net job losses over the long term. Roughly a third believe AI will create entirely new categories of employment that offset those losses. That's not consensus, that's economic tension. History offers mixed comfort. When the Industrial Revolution mechanized agriculture, millions of farm jobs disappeared, but manufacturing boomed. When computers automated clerical work, new tech sectors exploited entire professions emerged that no one could have predicted decades earlier. The question is whether AI follows the same pattern or accelerates disruption faster than new roles can form. Because this time, the speed is different. AI tools can be deployed globally in months, not decades. A software update can instantly enhance productivity across thousands of firms. That compresses the adjustment period for workers, and labor markets don't always adjust gracefully under compression. Consider economies like the United States, where service sector and knowledge-based employment dominate. If AI meaningfully reduces demand for mid-level cognitive tasks, think junior analysts, entry-level programmers, administrative coordinators, the career ladder itself could shift. That matters. Many professions rely on entry-level roles as training grounds. If those roles shrink, how do workers gain experience to move upward? AI may not just eliminate jobs, it may alter career pathways. Meanwhile, in fast-scaling tech hubs, companies such as Microsoft and Google are integrating AI deeply into their products. This increases demand for highly specialized AI engineers and researchers, but not everyone can pivot into advanced machine learning overnight. That creates polarization. High-skill, high-income workers who can leverage AI may see productivity and wages rise. Workers performing routine cognitive tasks could face downward pressure, and regions without strong digital infrastructure may struggle to adapt at all. Governments are watching closely. Some policymakers argue that AI will free humans from mundane tasks, enabling creativity and entrepreneurship. Others worry about structural unemployment and social instability. Education systems are being urged to teach adaptability, digital fluency, critical thinking. But adaptation takes time, and markets move faster than policy. There's also a subtle psychological shift happening. When workers see AI perform tasks they once considered uniquely human, writing reports, generating art, offering legal drafts, it challenges identity as much as employment. Economic change is rarely just about income. It's about purpose. So where does this leave us? In the short term, the labor impact may appear manageable. Modest displacement, gradual integration, optimistic corporate messaging. In the long term, the picture is less certain. AI could generate entirely new industries we can't yet imagine, just as the internet gave birth to digital marketing, app development, and cloud architecture. Or it could consolidate power among capital owners while reducing broad-based labor demand. The truth is, both outcomes are possible. And that uncertainty is the real story. The AI investment boom isn't only reshaping balance sheets, it's reshaping the future of work itself. So here we are, trillions of dollars committed, power grids under pressure, productivity promises hanging in the balance, labor markets quietly bracing for impact. The AI investment boom has moved far beyond tech headlines. It now sits at the center of macroeconomic strategy, corporate dominance, and geopolitical rivalry. And the final question lingers like a shadow over every earnings call. Is this a bubble, or the foundation of the next economic era? History loves patterns. The railroad boom of the 19th century ended in overcapacity and bankruptcies, but it also laid the physical backbone of modern commerce. The dot-com bubble of the late 1990s collapsed spectacularly, yet from its wreckage emerged durable giants that still define the digital economy today. Today's AI boom carries echoes of both. On one hand, capital expenditure is staggering. Companies like Nvidia, Microsoft, and Google are investing tens of billions into infrastructure, chips, and research. Valuations have soared on the assumption that AI will deliver exponential returns. On the other hand, unlike many past bubbles, AI is already embedded in real workflows. It is not a concept demo. It is operational. Businesses are automating customer service, accelerating research, optimizing logistics, and redesigning software pipelines. That makes this boom uniquely dangerous and uniquely powerful. Dangerous because expectations are sky high. Markets are pricing in productivity surges, margin expansion, and long-term dominance. If returns underwhelm, corrections could be brutal. Powerful because the underlying technology genuinely enhances capability. AI systems can reduce costs, increase output, and unlock entirely new business models. In economies like the United States and China, policymakers are not treating AI as optional innovation, they are treating it as strategic infrastructure. That's a major shift. Artificial intelligence is no longer just a sector. It is becoming foundational, like electricity, like the internet, like telecommunications. And when something becomes foundational, its ripple effects spread everywhere. Financial markets, concentration risk grows as mega-cap firms dominate index performance. Energy markets, demand forecasts are being rewritten. Labor markets, skill premiums are widening. Global trade, chip supply chains are now geopolitical flashpoints. The AI boom is not happening in isolation. It intersects with climate policy, industrial policy, national security, and monetary policy. And here's the deeper irony. Even if parts of the market are overvalued, even if some AI startups collapse, the infrastructure being built will remain. Data centers will not vanish. Grid upgrades will not be reversed. Talent pipelines will not disappear. In other words, even a correction could leave behind a stronger technological base. That's what makes this moment historically significant. We are not just watching another tech cycle. We are watching a reallocation of capital on a scale that reshapes economic structure itself. Wealth may concentrate before it diffuses. Power may centralize before it redistributes. Volatility may spike before stability returns. But one thing is clear, the AI investment boom is forcing the global economy to confront its physical limits, its inequality gaps, and its productivity ambitions all at once. Whether it ends in tears, triumph, or something in between will depend on energy, capacity, regulatory balance, labor adaptation, and realistic expectations. The ripple effects are already underway, and decades from now, historians may look back at this period not as a hype cycle, but as the moment intelligence itself became capital. The question isn't whether AI will change the economy. It already has. The real question is, who will control the outcome? The AI revolution isn't coming, it's already rewriting the global economy. From energy shortages and data center expansion to productivity gains in the United States and China, the ripple effects are accelerating. The big question remains, will artificial intelligence create widespread economic growth, or deepen inequality and market concentration? As capital floods into AI infrastructure and automation transforms the labor market, the stakes couldn't be higher. Investors, policymakers, and workers are all navigating uncertain territory. If you found this breakdown of the AI investment boom insightful, make sure to subscribe, like the video, and turn on notifications for more deep dives into global economics, financial markets, and emerging technology trends. The future of AI, productivity, and economic power is unfolding in real time, and you, Don T, want to miss what happens next.